Welcome. In this video, can Zbcn coin increase by 1200% and make a heart attack? We will analyze this. Don't forget to subscribe and like, and please watch to the end to understand.
First of all, the concept of a bullish order block located just below the price is extremely important in terms of technical analysis because such zones indicate that buyers strongly stepped in at that level in the past, pushed the price upward, and created an area that left a mark on the market. Order blocks often carry the traces of high-volume transactions made by large institutional investors and professional traders, which is why they are among the most closely watched structures in the market. If the price pulls back toward this block level, the likelihood of new buyers stepping in there is quite high. Since there was strong demand in this area before, many traders and investors see this level as a potential buying opportunity and believe the price will bounce from this point. For this reason, a bullish order block is considered one of the strongest support structures below the price. Price movements never move in a straight line. They constantly fluctuate, and during these fluctuations, the presence of strong buyers or sellers at certain levels becomes evident. This is exactly where bullish order blocks come into play. A bullish order block is generally defined as the zone formed by the last bearish candles right before a strong upward move begins. This area shows that buyers took control and created significant pressure to push the price higher. Therefore, when the price revisits this area in the future, the likelihood of the same buyers or a similar group stepping in again is high. This is a phenomenon frequently observed in technical analysis and is based on a logic often used in traders' buying strategies. When the price retests the same area that caused it to rise strongly in the past, it usually reacts in a similar way. Now let's imagine the price is currently approaching the bullish order block. In this case, market participants mentally prepare even before the price reaches it. Many traders mark this area on their charts, set alerts, or place pending orders. So when it gets there, there's a very high probability of a sudden increase in trading volume. An increase in volume means buyers are stepping in quickly, which makes it easier for the price to show an upward reaction. For this reason, the price bouncing from the bullish order block is not just a random possibility, but rather a natural consequence of past institutional footprints and market psychology. At the same time, when the price reaches this area, not only a technical but also a psychological process begins. Many investors see this area as the last stronghold. If the price reacts here, market confidence grows and a strong foundation for the continuation of the uptrend is formed. On the other hand, if the price breaks this block and closes below it, then it is thought that the decline will deepen further. Therefore, bullish order blocks are not only support levels, but also critical turning points that determine the market's direction. That's why the reaction shown when the price reaches them is of great importance for the future of the trend. Another reason why the probability of the price bouncing from the bullish order block is high is the strategies of institutional investors. Large funds and professional investors usually prefer to buy at lower levels because this allows them to achieve greater profits. For them, bullish order blocks are opportunity zones where liquidity is high and where they can enter the market with large volumes. While small investors tend to buy at points where the price rises quickly, big players mostly wait for pullbacks and target bullish order blocks during these retracements. Therefore, when the price reaches this area, strong buying orders naturally come into play, making it easier for the price to react upward. For this reason, the price bouncing from the bullish order block is not just a random possibility, but rather a natural consequence of past institutional footprints and market psychology. Another factor supporting the effectiveness of bullish order blocks is the market's liquidity structure. Prices in markets tend to move toward areas with liquidity because there are more orders there. Bullish order blocks host a large number of pending buy orders beneath them, so it is natural for the price to head toward this zone. When the price reaches it, liquidity is absorbed, and then the price reacts upward. In other words, the price bouncing from the bullish order block is also a natural result of the law of liquidity attraction. In this context, bullish order blocks are not just a box visible on the chart, but also a reflection of money flow and order balance in the market. The price bouncing from the bullish order block is also a positive sign for the continuity of the trend. If the market is already in an uptrend, reactions taken from these blocks show that the trend is progressing healthily. Uptrends usually move in waves, and the pullback points of these waves often coincide with bullish order blocks. Every time the price reaches them, a new upward wave begins, and in this way, the trend continues upward in a compounding manner. Therefore, the price reaching and bouncing from the bullish order block is both a factor that supports the trend technically and a psychological effect that reinforces investors' confidence. Sometimes the price may bounce from such zones not just once, but multiple times. Each bounce confirms how strongly the market sees this area as support. However, with each test, the block weakens somewhat because the buy orders there are gradually consumed. Still, especially in the first tests, these blocks tend to work strongly. That is why the first time the price reaches the bullish order block usually results in a big reaction. Investors are aware of this, so they tend to buy more confidently at first touches. In conclusion, a bullish order block located just below the price is a structure that carries great importance in the market, both technically and psychologically. When the price reaches it, the probability of buyers stepping in again is very high, and this makes it easier for the price to bounce upward. This phenomenon is not only a repetition of past price movements, but also a natural reflection of market psychology, institutional strategies, and liquidity balance. Therefore, the price reaching and bouncing from the bullish order block is evaluated as a positive scenario in market analysis and offers a strong buying opportunity for investors. Especially in uptrends, the importance of these blocks increases even more because the reactions taken from these levels play a vital role in the continuation of the trend. But we can't make a decision based only on the order block, so let's also look at the other metrics. Keep watching.
The Bollinger Band is one of the most powerful indicators in technical analysis for measuring price volatility, identifying support and resistance zones, and predicting the potential direction of price. This indicator consists of three main bands: the upper band, the lower band, and the middle band. The middle band is usually taken as the 20-period simple moving average and shows the short to medium-term overall trend of the price. The upper and lower bands are drawn a certain standard deviation above and below this moving average. At this point, a pullback from the upper band toward the middle band is a highly critical technical detail. By design, when the price touches the upper band, it signals overbought conditions, while approaching the lower band signals oversold conditions. Therefore, when the price moves downward from the upper band, this movement can be considered a correction. Especially when the price begins to move toward the middle band, market participants closely monitor this area because the middle band acts both as a strong support level and a zone confirming the trend direction. When the price reaches the middle band, it often either receives strong support and reacts upward or breaks through the band and moves further down toward the lower band. In the scenario described, the price is pulling back from the upper band toward the middle band. This may occur as buyers take short-term profit following the previous upward move. In other words, when the price touches the upper band and gives an overbought signal, some investors may close their positions and exit the market. These sales naturally push the price toward the middle band. However, by nature, the middle band often serves as an equilibrium point for the price. The price frequently consolidates around this band because it represents the fair value region of the market. For investors, what matters is how the price reacts when it reaches the middle band. If buyers step in strongly, the price reacts upward from this band and may climb back toward the upper band. This indicates that the trend remains strong and buyers still dominate the market. A reaction from the middle band also serves as a psychological threshold. The Bollinger Middle Band is seen as a strong support or resistance area, particularly by traders analyzing trend continuity. In an uptrend, the price generally moves above the middle band and strong buying occurs on every pullback to it. Therefore, a reaction from the middle band signals that the price is respecting the trend and the upward movement is likely to continue. If this reaction is strong, the price quickly heads back toward the upper band and begins testing it again. This boosts investor confidence and creates a psychological foundation for further upward movement. The volume displayed by the price as it approaches the middle band is also very important. When the price moves toward the middle band with decreasing volume, it generally indicates a healthy correction, increasing the probability of a strong bounce upward from the middle band. However, if the volume increases as the price nears the middle band, it may signal that sellers are gaining strength. For an optimistic interpretation of this scenario, the expectation is that the price will find support at the middle band and that buyers will step in. The logic of the Bollinger Band supports this, as the middle band often acts as a zone confirming the price direction and a point where buyers re-enter. Additionally, a bounce from the middle band represents an opportunity point for investors to take positions. Many investors take profits when the price approaches the upper band, and they step in to buy again when the price reaches the middle band. The cycle repeats continuously in the market, allowing the middle band to provide a foundation for upward price movements. Furthermore, this reaction is not just a short-term bounce, but often ensures trend continuity. When the price finds support at the middle band and moves upward again, market participants see this as a strong indicator of an uptrend and support the price further by buying more. The psychological effect of the Bollinger Band should also be noted. Investors generally view the upper band as expensive and the lower band as cheap. The middle band acts as a balance point between these extremes. Therefore, when the price falls from the upper band to the middle band, investors often think it is approaching a suitable buying area. This makes the middle band act like a magnet for the price, and once the price reaches it, strong buying drives it upward again. This increases the likelihood of a bullish reaction from the middle band. The volatility reflected by the Bollinger Band is also important at this point. If the bands are narrow, the market is consolidating, and when the price reaches the middle band, the probability of a sharp upward breakout increases. If the bands are wide, it already indicates strong market movements, and a reaction from the middle band can be a strong signal for the continuation of the uptrend. Especially in uptrends, if the price consistently finds support at the middle band without breaking it, this confirms the strength of the trend. In other words, buyers stepping in as the price approaches the middle band indicates that the market still has upward potential. In conclusion, a pullback from the upper band to the middle band and the possibility of a reaction upward from there is a highly positive technical scenario. If the scenario occurs, the price moves back toward the upper band, continuing its upward trend.
The ascending channel formation is one of the most reliable and closely followed patterns in technical analysis. This formation shows that the price fluctuates regularly within a defined channel, finding strong support each time it touches the lower band and encountering resistance at the upper band. Such a structure provides investors with critical insights into both the direction and potential of the market. Currently, the price being at the lower band of this ascending channel is considered a highly positive signal, indicating that the long-term uptrend may continue. At this point, the price is typically in a zone where buyers step in most strongly and the forces driving the trend upward are most concentrated. Especially in the current situation, the potential for a move toward the upper band, suggesting a 1,200% increase, creates an exciting expectation for investors. To understand this scenario, it is first necessary to grasp the nature of the channel. An ascending channel is a process in which the market continuously produces higher lows and higher highs. Each pullback holds above the previous level, and each rise surpasses the prior peak. This regular structure indicates that the market is in a strong trend and that participants support this trend. Being at the lower band signifies that the price is currently in a corrective phase, but the overall trend remains intact. Within such a structure, a move back toward the upper band is almost inevitable, as market participants want to maintain the main direction of the trend. Viewed in this way, the enormous 1,200% potential increase is not just a technical possibility, but also an expectation supported by investor psychology. During the process of moving the price from the lower band to the upper band, certain catalysts usually come into play. These can include increased trading volume, positive market news, and aligned signals from strong technical indicators. Among these factors, volume is particularly critical, as growing buying pressure at the lower band boosts investor confidence and accumulates the energy needed to drive the price upward. This energy transforms into a strong upward move toward the upper band. For a 1,200% increase to be feasible, the width of the channel and the ratio between current price levels must indeed be substantial. This scenario offers investors the opportunity for significant gains if they patiently wait over the long term. Being at the lower band also represents a low-risk entry point. Investors can place stop levels very close to the lower band, minimizing risk while maintaining high potential returns. From a risk-reward perspective, such a scenario is a rare opportunity in the investment world. As the price progresses toward the upper band, surpassing each intermediate resistance level increases market confidence and draws new investors into the process. This chain reaction accelerates the movement and makes the targeted 1,200% increase more realistic. Additionally, this upward scenario holds significant psychological importance. In a market where investors are accustomed to the price repeatedly bouncing from the lower band, they anticipate the same scenario to occur again and step in to buy. This crowd psychology acts like an invisible force propelling the price upward. Once the rally begins, each new peak attracts additional buyers and strengthens the trend. Large moves of this type, patiently awaited by long-term investors, often become the most profitable opportunities. Reaching the upper band is not only an achievement in terms of price, but also proof of the trend's solidity. When the upper band is reached, it confirms that investor expectations are met and the market is maintaining its trend regularly. This boosts confidence and opens the door for further investments. The 1,200% increase represents not just a number, but a symbol of market strength, trend stability, and the combined psychology of investors. The price being at the lower band may initially appear intimidating, as the thought of continued decline arises. However, technically, this point is actually where opportunities are most concentrated. While many investors act out of fear, patient and informed investors view these levels as an advantage. As long as the channel remains intact, the trend continues, supporting upward movement. In long-term technical analysis, the lower band support role is nearly an unbreakable barrier, providing investors with confidence. Moreover, the potential for a 1,200% increase signals not just a short-term spike, but a long-term uptrend. This shows that investors should consider not only immediate gains, but also future major opportunities. The journey from the lower band to the upper band represents not just price growth, but also a test of confidence, patience, and strategy. Investors who correctly navigate this process ultimately reap substantial rewards.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.